warahmatullahi wabarakatuh. For the group assignment, we are required to highlight what are the issues mentioned in an article. But before we go deeper about that, let's go through the definition for a few types of financial instruments. Firstly, financial liabilities. According to IAS 32, financial liability is any liability that is a contractual obligation which is to deliver cash or another financial asset to another entity or to exchange financial assets or financial liability with another entity under conditions that are potentially unfavorable to the entity, or a contract that will or may be settled in the entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instrument, or a derivative that will or may be settled other than by exchange of fixed amount of cash or another financial assets for a fixed number of the entity's own equity instruments. The common examples are trade payables and bank borrowings. Next, the definition of financial equity is the reverse, or as opposed the definition of financial liability as I mentioned before. So in short, an issuer of an equity instrument does not have an unconditional obligation to deliver cash or other financial instruments. So examples are such as ordinary shares. Lastly, compound or hybrid financial instrument. Generally, hybrid means something made by combining two different elements. So hybrid financial instrument is a non-derivative instrument that have both features of financial liability and equity instruments. The most common example is a bond that can be converted into shares, which is known as convertible bonds.
I will explain further the problems related to the issue in the article. The first problem is the complexity and difficulties in applying the principle of IAS 32. This is because compound financial instruments have the characteristic of both liability and equity. Besides, securities with those characteristics can be designed with a wide range of complex features such as the interest rate benchmark, the duration of principal repayment, determination of conversion, and the number of shares. Hence, each feature must be examined to determine whether it is a separate component, a liability, equity, or derivative, or whether it affects the classification of another component. Next, there could be a problem identifying or valuing the components or determining the treatment of an unusual premium in practice IAS 32. For instance, the split accounting required by IAS 32 for short-term convertible notes may result in complex accounting. This is because if the notes convert into share based on the share price at the time of conversion, the entire instrument will be classified as debt, and it can be difficult to value the components, particularly for small businesses. Furthermore, there is a principle for debt equity classification in IAS 32. Generally, the classification is made upon initial recognition and is not changed later. Thus, according to IAS 32, paragraph 16, it involves two steps. Firstly, the entity must consider whether the individual instrument or class of instruments issued by the entity is a financial liability or equity. Second, whether the entity settles an obligation with instrument issued by itself that could be classified as equity in isolation. According to IAS 32, the entity must consider whether the instrument is a financial liability. Moreover, IAS 32 focuses on contractual right and obligation rather than the likelihood of cash and other resource outflows associated with those rights, like contingently convertible bonds. The contractual obligation of the financial instruments issuer to deliver another financial instrument to the holder is an important feature in distinguishing a financial liability from equity. In addition, according to IAS 32, financial instruments must be classified based on substance rather than form. They may be the same in most cases, but there are instances where items are equity in legal form but liabilities in substance, and vice versa. In practice, instruments that are perpetual debt must be classified as equity instruments.
4 ways the standard setters could respond to the problems. Firstly, we have to improve the definition of a liability. Standard setters have adjusted the dividing line between liabilities and equity by adding or removing exceptions, but they have not reached agreement on approaches. They suggest that additional rules and guidance to make the liability-equity distinction clearer cannot achieve consistency in the classification of compound instrument. Thus, standard setters are not able to arrive at definition for asset, liabilities, and equity that are broad enough to accommodate commercial variation. Secondly, improving the separation of component approach. The component approach may solve some of the problems because an instrument with mixed characteristics can be split into separate components, but the component approach will not provide a solution if such definitions are not available. Another problem is there will be more than one way of dividing the instrument into different parts. Components also will need to be measured for valuation purposes, involving models and assumptions, and possibly leading to estimate which may be non-comparable. Thus, we conclude that the solution does not lie solely in improving the component approach. Thirdly, improve accounting through enhancing disclosure. The dichotomous step equity classification focusing only one characteristic related to the nature of the claim. However, the inherent complexity of compound instrument cannot be addressed by a singular relevant characteristic. Presently, the process of valuing ordinary equity benefits the least from existing disclosure requirement. Under IFRS 7, no disclosure is required for instrument classified as equity, and this showed the needs for improvements in disclosure in this area. Further, research suggests that the disclosure of a large number of parameters would be needed to adequately illustrate the valuation model presently used in financial analysis.
So for my part, I will explain about the next point, which is the mezzanine approaches. Compound instruments were previously classified as mezzanine under some accounting standards. By emphasizing the presence of compound instruments, the mezzanine improved the information available to decision makers. Disclosure for the mezzanine category should help users comprehend the instrument's impact on solvency risk and potential dilution of or limits on ordinary shareholders' profit. Benefits of the mezzanine is that instruments with both equity and debt features will be lumped together in the mezzanine category without having to be divided down into separate. As a result, employing the mezzanine could simplify compound instrument accounting. However, there are certain disadvantages to using the mezzanine approach. To ensure that the dividing line between liability and mezzanine leads in meaningful distinction between the instrument in each category, the categories state require careful definition of liabilities and equities. Furthermore, the mezzanine category could be broad, including a huge class of instruments that combine elements from both the liability and equity extremes. The mezzanine category will require properly presenting items in the profit and loss statement that indicate interest expense or payment to owners. Overall, the use of mezzanine category does not eliminate the challenges of evaluating and remeasuring financial instruments. So, the next point is current approach in standard setting. The board's current approach to the FICE research initiative is focused on three objectives. The first one is to reinforce the underlying rationale of the distinction between liabilities and equities in IAS 32. Number 2, provide better information to representation and disclosure. Number 3, improve consistency, completeness and clarity of the requirement. The board now favour the gamma approach, which is based on the content fundamental rights and responsibilities. The board recommend that liability based on a residual amount be presented separately. It will apply to stand-alone and embedded the derivative that rely on residual amount as well as the income and expense associated with them in OCI. This method will provide additional liability information while avoiding some of the drawbacks of the mezzanine method. The board is considering the presentation of subclasses of equity with some income recognized in profit or loss or OCI being attributed to classes of equity other than ordinary shares. To reflect attribution, the correct amount of subclasses of equity will be adjusted. A mezzanine category has been explored by the board, but it is not currently being considered.
Standard setters have struggled with accounting for compound financial instruments for decades. There are 4 approaches provided that may help standard setters to use in further work on the problem, and those approaches are then being compared with the IASB's existing approach in solving the issues. The authors believe that the current approach is possible to improve the implementation of IAS 32 through enhanced presentation and disclosure, but underlying issues relating to judgment and estimates in evaluation will continue to exist. That's all from us. Thank you.